With the end of 2025 fast approaching, we hope that holiday planning is on schedule and wish all of you a healthy and prosperous new year. In November and December each year, investors talk about a Santa Claus rally, which describes a tendency, but not always, for equity markets to trade higher into year end. But another event that happens every December is the final scheduled meeting for the Federal Reserve Bank, or Fed's, Monetary Policy Committee, which this year met on December 10th. The Fed, of course, doesn't drive the economy, but its dual mandate is to promote maximum employment and stable prices, which is low and steady inflation. Its tools are managing very short-term interest rates, in fact, overnight lending rates in the banking system called federal funds or Fed funds. There's an axiom on Wall Street that equities will often rally when the Fed is lowering those Fed funds interest rates on the theory that economic activity can be stimulated as those rates come down. This gives rise to the term, "don't fight the Fed," as markets trade higher. Of course, nothing is that predictable, but on December 10th, the Fed enacted a quarter point or 25 basis point reduction in the Fed funds target to 3.5% at the low end of the target range. The Fed meets on average every 6 weeks, and this was the third consecutive meeting that ended with a rate reduction, each time for 25 basis points for a total of 3/4 of a point since September. In addition, the Fed announced that it will become more active in purchasing Treasury bills in the open market, which will add even more liquidity to the banking system. Investors reacted positively to the news, and the S&P 500 traded very close to an all-time high. In general, we advocate against making major portfolio decisions solely based upon individual Fed meetings, but we believe that Fed decisions over the past 3 months, along with expectations for solid economic activity in early 2026, is good for equity markets. Despite evidence of slowing jobs growth and inflation that remains closer to 3% than to the Fed's 2% target, key economic drivers are present. And this includes strong corporate capital investment driven by artificial intelligence or AI, data centers, and other investment helped by favorable tax incentives that were in the 2025 budget bill. And also resilient consumer spending that is expected to be boosted in early 2026 by tax refunds and lower tax withholding, also from the 2025 budget bill. These drivers, along with lower Fed funds rates and rising bank liquidity, can provide additional economic stimulus. We also believe that these factors could drive more broad participation in market gains, which means that market leadership could rotate away from the large company technology leaders and move to sectors and companies that have lagged this year. In the fourth quarter of 2025 through December 10th, technology and communication services, 2 sectors with large AI exposure, have posted solid gains, but the top performing sector for the quarter to date was healthcare, and energy, industrials, and consumer discretionary were positive as well. We look for equities to trade higher from current levels, and sector diversification allows investors to participate in expected gains while also managing risk. Risks include economic stimulus, creating additional inflation pressure, a pullback in consumer confidence due to weak labor markets, and valuation concerns driven by gains in the data center ecosystem. For specific recommendations and strategies, please contact your D.A. Davidson financial professional.